Welcome back to Top 10 Explorer. Today I'm revealing 10 stock market strategies specifically designed for beginning investors who want to build wealth without losing their shirts. These aren't get-rich-quick schemes or day trading tactics, they're proven strategies used by successful long-term investors to build substantial portfolios over time. I've spent years studying the approaches of legendary investors and analyzing what actually works for everyday people starting their investment journey. What I'm sharing today combines the wisdom of Warren Buffett, Peter Lynch, and John Bogle with practical strategies that beginners can implement immediately, even with small amounts of money. The biggest mistake new investors make is thinking they need to beat the market or find the next Amazon to be successful. Real wealth building in the stock market comes from consistent investing in quality companies and funds, avoiding major mistakes, and letting compound growth work over decades. Here's what most people don't understand about stock market success. It's not about being smarter than other investors or predicting market movements. It's about developing good habits, avoiding emotional decisions, and staying invested long enough for the market's upward bias to work in your favor. Number 10. Start with index funds. This is the perfect entry point for new investors because index funds provide instant diversification, professional management, and market-matching returns at extremely low costs. You're buying a tiny piece of hundreds or thousands of companies with a single purchase. Index funds that track the S&P 500 give you ownership in America's 500 largest companies, including Apple, Microsoft, Amazon, and Google. This diversification protects you from the risk of individual company failures while capturing the overall growth of the economy. The numbers are compelling. Over the past 50 years, the S&P 500 has averaged roughly 10% annual returns including dividends. A $500 monthly investment earning 10% annually grows to over $1.2 million in 30 years through compound growth. Warren Buffett famously bet that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. The index fund won easily, proving that low-cost, broad diversification beats expensive active management for most investors. Popular index funds include Vanguard's VOO, State Street's SPY, and Fidelity's FXAIX. These funds charge less than 0.1% annually in fees, meaning you keep virtually all of your returns. Number 9. Practice with paper trading. Before risking real money, use virtual trading platforms to learn how markets work and test different strategies. Paper trading allows you to experience market volatility and practice investment decisions without financial consequences. Platforms like Investopedia's Simulator, TD Ameritrade's Paper Money, and many brokerage apps offer realistic trading experiences using real market data. You can practice buying and selling stocks, researching companies, and managing portfolios. Paper trading helps you understand market psychology and your own emotional responses to gains and losses. Many beginners discover they're more risk-averse or risk-seeking than they initially thought. Use paper trading to test investment strategies and learn from mistakes without losing money. Practice dollar cost averaging, try different asset allocations, and experiment with individual stock picking before committing real capital. The key is treating paper trading seriously rather than making wild bets you wouldn't make with real money. Use realistic amounts and investment strategies you would actually implement. Number 8. Research before you buy. Never buy stocks based on tips, social media hype, or hot recommendations. Successful investing requires understanding what you own and why you expect it to increase in value over time. Company research starts with understanding the business model. How does the company make money? What products or services do they provide? Who are their customers and competitors? Is the industry growing or declining? Financial analysis involves examining revenue growth, profit margins, debt levels, and cash flow. Look for companies with consistent earnings growth, manageable debt, and strong competitive positions in their industries. Use resources like company annual reports, financial websites like Yahoo Finance or Morningstar, and brokerage research reports. Many brokerages provide detailed analysis and recommendations for stocks in their databases. Avoid companies you don't understand or industries undergoing rapid disruption unless you have specific expertise. Stick to businesses with clear value propositions and predictable revenue streams. Number 7. Set stop-loss orders. These automatic selling instructions protect your investments by limiting losses if stocks decline significantly. Stop-loss orders remove emotion from loss-cutting decisions and prevent small losses from becoming portfolio disasters. A typical stop-loss strategy involves selling if a stock drops 10 to 15% from your purchase price. This limits your maximum loss on any individual position while allowing room for normal market volatility. The key is setting stop-loss levels based on technical analysis or your risk tolerance rather than arbitrary percentages. Some volatile stocks might need wider stop-loss margins, while stable stocks might warrant tighter controls. However, stop-loss orders aren't perfect. They can trigger unnecessary sales during temporary market panics, causing you to sell at the worst possible time. Use them as tools, not rigid rules. Consider mental stop losses for long-term investments where you reassess positions that decline significantly rather than automatically selling. This approach requires more discipline but avoids forced selling during market volatility. Number 6. Focus on blue-chip stocks. These are shares of large, established companies with long track records of profitability and dividend payments. Blue-chip stocks provide stability and steady growth that's perfect for beginning investors. Examples include companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, and Microsoft. These businesses have survived multiple economic cycles and continue generating profits regardless of market conditions. Blue-chip stocks often pay dividends, providing income while you wait for capital appreciation. Many have increased their dividend payments annually for decades, creating reliable income streams that grow faster than inflation. These stocks are generally less volatile than smaller companies or growth stocks, making them easier to hold during market downturns. Their stability helps new investors develop confidence and avoid panic selling. Start with companies you know and use daily. If you drink Coca-Cola, use Microsoft products, or shop at Walmart, you already understand these businesses better than complex technology or biotech companies. Number 5. Buy and hold strategy. This is Warren Buffett's signature approach and the strategy that has created more wealth than any other investment method. Buy quality companies and hold them for years or decades, ignoring short-term market volatility. The buy and hold strategy works because stock markets trend upward over long periods despite short-term fluctuations. Temporary declines become buying opportunities rather than reasons to panic. Time in the market beats timing the market. Investors who stay invested during volatile periods capture the full benefit of market recoveries, while those who try to time entries and exits often miss the best days. This strategy minimizes taxes because you only pay capital gains when you sell. Long-term capital gains rates are lower than short-term rates, improving your after-tax returns significantly. Buy and hold requires patience and conviction in your investment choices. Focus on companies with durable competitive advantages in growing markets that can compound wealth over decades. Number 4. Invest in what you know. Peter Lynch popularized this strategy during his legendary run managing the Fidelity Magellan Fund. Start with companies in industries you understand through work experience or personal interests. If you work in healthcare, you might understand pharmaceutical or medical device companies better than the average investor. If you're passionate about technology, you might spot trends in software or hardware companies before they become mainstream. This doesn't mean only investing in your industry, but it means starting with familiar territory where you can evaluate competitive advantages and growth prospects more accurately. Your everyday experiences as a consumer provide investment insights. Notice which stores are always busy, which products are gaining popularity, or which services are improving customer satisfaction. Combine your personal knowledge with financial analysis to identify companies that are both good businesses and good investments at reasonable prices. Number 3. Dollar cost average your purchases. Instead of trying to time the perfect entry point, invest the same amount regularly regardless of stock prices. This strategy reduces the impact of volatility and eliminates the stress of market timing. When stock prices are high, your investment buys fewer shares. When prices are low, the same investment buys more shares. Over time, this averages out to a reasonable cost per share without requiring you to predict market movements. Dollar cost averaging works particularly well with index funds or individual stocks you plan to hold long-term. Set up automatic investments that execute monthly or quarterly regardless of market conditions. This strategy also builds investing discipline by making it systematic rather than emotional. You're less likely to stop investing during scary market periods if it's automated. Many successful investors use dollar cost averaging for their core holdings while occasionally making larger purchases during obvious market opportunities. Number 2. Reinvest dividends automatically. Dividend reinvestment plans allow you to use dividend payments to purchase additional shares rather than receiving cash. This harnesses the power of compound growth by turning your dividends into more dividend-paying shares. Over time, dividend reinvestment can dramatically increase your ownership in quality companies. Shares purchased with reinvested dividends generate their own dividends, creating exponential growth. Most brokerages offer automatic dividend reinvestment at no cost. This removes the temptation to spend dividend payments and ensures they continue working to build your wealth. Dividend reinvestment is particularly powerful during market downturns when your dividends buy more shares at lower prices, setting you up for greater gains during the recovery. This strategy works best in taxable accounts where you want maximum growth rather than current income. In retirement accounts, you might prefer to accumulate cash for rebalancing or other investments. Number 1. Think like a business owner. When you buy stocks, you're purchasing pieces of real businesses, not just ticker symbols that move up and down. This ownership mindset leads to better investment decisions and longer holding periods. Ask yourself, would I want to own this entire business? Do I understand how it makes money? Does it have competitive advantages that will allow it to grow over time? Is management capable and trustworthy? Business owners don't check their company's value every day or panic when temporary problems arise. They focus on long-term growth prospects and competitive positioning. This mindset helps you ignore short-term price fluctuations and focus on fundamental business performance. Stock prices eventually reflect business results, but they can deviate significantly in the short term. Successful investors like Warren Buffett buy stocks with the intention of holding them forever if the businesses continue performing well. This long-term perspective leads to superior returns and lower stress. Here's the truth about stock market success. It's not about finding the next hot stock or timing the market perfectly. It's about developing good habits, staying disciplined during volatile periods, and letting compound growth work over decades. Your stock market journey should start with these foundational strategies rather than attempting complex trading techniques or speculative investments. Master the basics first, then gradually expand your knowledge and strategies. The most important factor is starting, even if you can only invest small amounts initially. Every successful investor began with their first purchase, and there's no reason you can't build substantial wealth using these proven strategies. Remember that investing is a marathon, not a sprint. The investors who get rich quickly often lose it just as fast. Focus on steady, consistent wealth building through proven strategies. Which of these stock market strategies will you implement first? Drop a comment below and tell me about your investing goals. I love hearing from viewers who are starting their wealth building journeys. If this video gave you confidence to start investing in the stock market, please give it a thumbs up and share it with someone who needs this guidance. Subscribe to Top 10 Explorer and hit that notification bell for daily investing education and wealth building strategies. Thanks for watching, and remember, the best time to start investing was yesterday, but the second best time is today. Your future wealthy self is waiting for you to take action.